Hi everyone, and welcome to the briefing for the March year-end accounting reminders. The full accounting reminders are available as a PDF on Inform. Over the next few minutes, I will discuss some of the key issues, which include climate change, COVID-19, IBOR reform, and supplier finance arrangements. If you're interested in only a particular topic, then you can jump to that section by referring to the timestamps below this video. First up, climate change. There continues to be an unprecedented level of attention around climate-related reporting from governments, regulators, and investors. The UK regulator, the FRC, has recently announced that they will be performing a review of companies and auditors on the impact of climate-related reporting in the coming months. For the financial statements, companies should be considering the impact, amongst other things, of climate change on impairment under both IFRS 9 and IAS 36, fair value measurement, and provisions. Companies should also be considering the impact of climate change on front half reporting, including in the risk disclosures, in the non-financial information, in the Section 172 statement, and in viability reporting. Another topical issue of the moment is COVID-19. At the time of filming, COVID-19 is having an unprecedented impact on business and economic activity globally. In a similar way to climate change, companies should be considering the financial impact on things like impairment and fair value measurement, but should also be thinking about the impact over the next 12 months for the going concern assessment. For example, any liquidity issues or impact on banking covenants. In light of the impact that COVID-19 has had on business, companies should consider whether their principal risk disclosures are complete. This will vary depending on the type of company. It may be that this is a manifestation of a risk that already exists, for example, availability of the workforce or supply chain disruption, or it may be that this warrants a separate risk disclosure. Now on to IBOR reform. So, since the financial crisis, the replacement of interbank benchmark interest rates, known as IBORs, have become a priority for global regulators and are expected to be replaced in around 2021. These rates are used in a range of financial contracts for the benchmark interest rates, for example, in loan agreements, in derivative instruments that are used for hedging arrangements, and perhaps even in lease arrangements. Given we are anticipating a change in rates, this has raised some questions in the accounting world as to the impact on hedge accounting, which requires, for example, an assessment of whether cash flows are highly probable and prospective assessments on hedge effectiveness. As a result, the IASB has issued some amendments to IFRS 9, IAS 39, and IFRS 7 that provide temporary relief from applying some specific hedge accounting requirements to hedging relationships that are impacted by IBOR reform. The amendments are mandatory and should be applied for annual periods beginning on or after 1st of January 2020, but early application is permitted. We expect an exposure draft on Phase 2 of the IASB's project in April, which will focus on financial reporting issues that may arise when IBOR is either reformed or replaced. Now on to supplier financing arrangements. Accounting for these type of arrangements have gathered significant attention from regulators since the failure of Carillion, with focus, amongst other areas, on a company's sources of finances. This includes whether a company has made material use of supplier finance arrangements, whether this is transparent from the annual report, and whether these amounts are recorded correctly as either bank debt or trade creditors, and whether cash flows are subsequently recorded in the statement of cash flows. In the UK, the regulator has indicated that it expects better disclosures from companies than they are currently providing. The exact accounting for different supplier finance arrangements will depend on the facts and circumstances relating to them. We continue to see a large number of questions on the restructuring of issued debt instruments, for example, loan facilities or bond financing, and modification of derivatives to take advantage of low interest rates. This is a complex area of accounting, which can require significant judgment. To help companies in understanding the potential issues, in our PDF document, we have summarised some of the key accounting considerations. These include determining whether the new and old debt have substantially different terms, treatment of gain or loss on modification or extinguishment of debt, treatment of fees incurred as part of the renegotiation, use of an intermediary, and modifications of derivatives. Impairment is an ongoing area of concern for many of our clients and is definitely a focus area of the regulator. So, some reminders when you're undertaking your impairment analysis for your March year-end accounting period. In assessing the impairment, the carrying value should be determined on a consistent basis with the recoverable amount. When you're doing a value in use model, it should be done on a pre-tax cash flow basis with a pre-tax discount rate. For the fair value model, which is a post-tax model, you must use market participant assumptions rather than those of management. The required disclosures for IAS 36 are extensive. They require disclosures of the key assumptions and related sensitivity analysis. So thinking about what the key assumptions are, the regulators have said that whilst the long-term growth rate used for extrapolating the cash flows and the discount rate are important, these are not necessarily the key assumptions for the impairment assessment overall, and therefore companies should be thinking about discrete growth rate assumptions applied to the cash flows projected to occur before the terminal period, and also whether the key assumptions used stand up against external market data. Many groups with European operations undertook restructuring in the anticipation of Brexit. This generally involves the disposal of an entity, business, or group of assets within the same group of companies. Any disposal or planned disposal or transfer of a non-current asset, group of assets, or business might trigger the requirements of IFRS 5, even if the disposal occurs within the same group or subgroup of entities. The method of disposal will impact how IFRS 5 is applied. As a reminder, non-current assets or disposal groups classified as held for sale or held for distribution are measured at the lower of the carrying value and the fair value less cost to sell, not depreciated or amortized, and presented separately in the balance sheet. Assets and liabilities should not be offset.